So welcome everyone to the Rosecut update in June 2023. I'm joined by Mike. It's been a while since we've done one of these, Mike, as we've moved to a quarterly format rather than monthly. I think it's fair to say a lot's gone on in the last quarter, but it hasn't actually translated through to very volatile markets, has it?
No, we could almost do this weekly, given there's so much going on, but in some respects, better to take a longer view. I think what's interesting is that volatility, almost as an asset class, has dropped right off. We had the settlement of the debt ceiling. I think, generally speaking, earnings have been quite strong. Inflation is still with us. It's come off at the edges. And I think also there is an apparent reluctance, certainly on the Fed, to be really aggressive with monetary policy. There's this ambivalence between what they're doing and some of the rhetoric. Now, some of this can reverse in the near term, but I think we are approaching a point where people are becoming complacent in terms of how volatility is being priced, given, as you say, there are so many things happening in the world.
Yeah, let's dig into some of those subjects. I mean, volatility can be measured by an index called the VIX, sometimes known as the fear index. And if you look back over the last sort of 3 years in particular, we're at the lows for that measure. And that means that, as you say, it can be a sign that investors are getting a little bit complacent because they're not pricing much by way of expected volatility into markets. And there's a bit of mean reversion that often occurs with these things. I suspect part of the reason why the VIX, why investors are feeling a bit complacent, is because economic growth has actually held in there a bit longer than expected. And for those that can see our screen, this is the grey line on this chart. Now, the leading economic indicators, they're actually quite negative, and they're suggesting that GDP growth will turn down further ahead. But as I say, it's hanging in there for now, and that's surprised people this year.
Yeah.
And I suspect it's still the lagging impact of the fiscal policy that we took during COVID, even though monetary is tight.
That's true. And I think we keep getting asked the question, will there be a recession or not? I think it's a difficult question to answer because officially, in terms of the headline numbers, GDP, etc., we are getting into a recession. There are some sectors like the housing market in China and the US and the UK that is weak. The services sector, by contrast, is in a completely different economic cycle, as is the labour market. That leads me to think that people don't quite feel that we're in a recession. It also leads me to think that central banks probably have to lean into labour markets and the services sector in terms of raising rates a little bit more and keeping them higher for longer to really cool down inflation, which looks to me to be quite sticky, actually. The latest numbers we've had show a dip in inflation, but a lot of that has been due to falling fuel costs, actually.
Yeah. So, I mean, you mentioned the housing sector. In fact, let me cover oil first, because oil, if you look back 12 months, and that's the number that's going to feed into your inflation number, which is year over year. A year ago, we were touching $120 on the crude oil index known as WTI. We're now at about 70. And that means that all the energy components, which are within the US inflation numbers, are actually negative year on year. So they're bringing down the headline number of inflation. But when you look at core inflation, which is a measure of inflation that excludes energy and food because of their volatility, that's staying quite sticky. That's at about 5%. And that's a function of the housing market hanging in there. And more importantly, wages in the US, they continue to run at a high level, given unemployment's also remaining relatively low.
Yeah, exactly. And then I think what is perhaps interesting in the context of this dichotomy or contrast between the manufacturing and the services sectors, we're having this disagreement between the bond market and the equity market. And you have the slide of bond deals there. And what is interesting is that equities continue to be strong while interest rates are rising. Even in the States, bond yields are now pushing 4%. In the UK, we've now gone through the level on 10-year gilts that caused trust to resign. So we're getting upward pressure on yields. Equity markets not yet worried about that, but I'm watching the gilt market, watching real yields as well, which is inflation-adjusted yields. They all suggest that equity should be lower if they follow the tempo of the bond market.
In fact, we've got an example of And when you dig into some of these indices, and I'm taking the US indices here, when you look at some of the bigger stocks in there, like Apple, the share price has remained very strong. In fact, Apple's share price, I think, is at an all-time high, much to my surprise. But when you look at a basic valuation metric, like the price relative to the earnings, and even if you're using forecast earnings, so what the market expects them to earn over the next 12 months, we're at levels that are quite expensive. And what this essentially means is that if you're paying 29 times earnings, that's a lot more than you paid in the past. It used to be more like 16 times was the sort of level we pay. And essentially that's pricing in a lot of good news. So Apple might probably continue to be a good company, and it's launching the new, I think it's called a Vision Pro, isn't it? And that might do very well, but a lot of it looks like it's already in the price. So the conclusion there is there's probably a better time to hold more equities.
Yeah, I totally agree. And that's such a big chunk of many indices as well. We haven't even talked about Nvidia trading 30 times sales. So if you hold it today and you want a future return, I mean, the sales growth on that is going to have to be phenomenal. So again, I think echoes of the dot-com bubble coming through in some of the indices as well.
Yeah, I think that's a great segue, because a lot of people have asked us what we think of AI and whether we should be doing something to take advantage of stock prices and driven by the growth of AI. And the example I'd like to draw here is Amazon in the dot-com period. So I've taken 5 years from 1997 to 2002. And basically, if you bought Amazon at its peak in 2000 because you believed the internet was going to change the world, you were right in your thesis about the internet having a big impact, but you were buying the stock at the wrong time. And so what happened is you had a 95% drop from its peak to its low in 2001. And it took until about 2010 for a share price to recover back to the level it was at in 2000. So the warning here is be careful with your timing on these narratives. Although you might eventually be proved correct, you really don't want to put up with the mental anguish of having a 95% drop and 10 years of patience.
Yeah. And of course, AI has been around what I find curious, it's been around for a very long time. And we've spoken about it before. I think all we're seeing now is sort of the public discovery of AI. Recently, there's not been a massive leap forward in technology. There's been more funding put into it. And I think that it's just coming more into the public domain.
Yeah. So overall for portfolios, we continue to remain defensive. We remain patient. We're confident there will be better buying opportunities in the future to use some of that cash that we hold. And for now, we continue to wait for those opportunities to present themselves.
Yes. Okay, Dan. Thanks very much.
All right. Thanks, Mike.